Let's bring in Max Kettner, Chief Multi-Asset Strategist over at HSBC. Max, good to have you back. Thanks for helping us kick off the week.
Thank you. Happy Easter.
I think I'm trying to remember, you have been looking for signals to put optimism to work, right? What do you see here?
Yeah, in fact, I mean, one of the things that kept us a bit wary of our overall pretty bullish stance, because indeed, when you look at the higher frequency data over the last couple of weeks, even throughout March, when you look at the labor market side and the consumption side, think, high frequency data on the labor market side, or think like credit card spending to gauge what consumer spending is doing. That's actually been solid. But one of the things that kept us a bit wary was the positioning side, because until very recently, we didn't get this overall pretty contrarian buy signal. We haven't had a pretty sort of strong signal where that would tell us, okay, everyone's pretty much out of the market. That, as of last week, is no longer the case. So as of last week, both systematic positioning, but particularly discretionary positioning, particularly around the hedging side of things, that's now really triggered the first proper buyer signal for the broader risk asset spectrum, really since the Liberation Day episode.
Right. Can I get you to say that Monday's closing low, 63.43, was the near-term low?
Yeah, I think so. I think with that kind of positioning data that we've got right now, I think it's going to be tough for equities and indeed for credit spreads, really for the broader risk asset spectrum, to fall below that low. So, I think it's pretty tough, because it's not only that, it's not only the hedging side, it's the systematic side, it's our momentum signals, it's surveys, look at investor intelligence, look at AAII. So it's a bunch of things, not just, okay, they're overhedged, maybe people are overhedged, but they haven't cut, and they're actually not telling us they're bearish. No, that's no longer the case. That perhaps you could have made that case 2-3 weeks ago. Now that's no longer the case. We are seeing that across the board, from hedging, from skews and put call ratios, to things like surveys, to things like systematic positioning as well. So I think very likely the low is in.
We just mentioned expectations for CPI later in the week. You think the runway is foamed for a hot number?
Yeah, I think, like you guys were saying, the really important reading is going to be core inflation, because on the headline number, who knows? I mean, I don't envy economists to model that kind of margin number right now. But I think the really important number is going to be the core number. If there's a 0.4, or let alone even a 0.5 on the core CPI number, that's not great news, because remember, until very recently, only 2 weeks ago, yields were pushing towards 4.5% on the 10-year. And there's one model we've got, which we call the danger zone, which is basically that kind of level of yields where it starts hitting all risk assets, and indeed every risk asset, where it's basically just about holding cash, being long dollar, and holding nothing else. Nothing works, whether it's EM, whether it's credit, whether it's rates, whether it's equities. Nothing protects you other than long cash and dollar. We're only about 15 basis points away from that level. Yes, we are a bit far away now, given the rally that we've had in treasuries in the last week and a half. But 15 basis points isn't a comfortable margin for safety. Really not. So I think a 0.4, 0.5 can very quickly bring us back into that danger zone. And that will spell trouble indeed, really, for the entire asset class spectrum, except for the greenback.